Parsky, the proposed small business early stage investment program has a specific focus on delivering capital to small businesses in some of the most capital intensive industry like biotech, clean energy, and life science. Can you discuss some of the policy justification for the program focus on these industries?
Yes, thank you, Madam Chairwoman. So I think this is a sort of two-part question. The first answer to the question gets to the policy justifications for the targeted industries as specified in the pending legislation. And particularly when it comes to biotechnology, clean technology, I think you see possibly the greatest combination of need for capital, especially in the current crisis that we're facing, as well as the potential for subsequent investment and job creation coming in from the combination of the public sector and private sector funding, which I'm assuming and hoping will be available once sufficient risk is taken out of the biofuels development or biotech development processes. I think in particular, talking about the biotech industry, this program would leverage America's existing strengths in technology generally and biotech in particular as we move to an increasingly knowledge-based economy here in the 21st century. It also, in the case of biofuels, would have the impact of bringing manufacturing of energy production into the U.S. and away from other parts of the world, whether it's OPEC countries or others that may not be so friendly. So from an energy security standpoint, I think that has value as well. Now, there's also a question about why target small businesses, early stage companies. And I think Congress and the administration and prior Congresses have indicated through things like the stimulus bill, through pre-existing grant and loan guarantee programs, renewable fuel standards and other regulations and tax policy, a strong national priority for developing biofuels, alternative energy or renewable technologies, energy technologies generally. And so there's already a serious policy commitment at the national level to support the advanced biofuel initiatives that I'm working on. Once that's done, though, one has to ask the question, are small businesses able to compete on a level playing field for some of the larger dollars that are really necessary to field a large demonstration facility to prove the economics of biofuels production as one example? And right now, what we're seeing through DOE and DOA programs, be they the grant programs or the loan guarantee programs, is small companies simply can't play in that environment because you can't even get an application together that satisfies DOE's or DOA's requirements based on out-of-pocket expenditures that are required, which are substantial, sometimes mid to high six figures. But the most important impediment is that you can't show the 20 to 50% cost share required on the grant side or the minimum equity required on the guarantee side to actually field your plant should you get the award.
Mr. Sabarsky, can you tell us what is the average return on equity for early stage
investment? Well, and maybe the panel coming next would be more appropriate. I'm not a venture capitalist. I don't play one on TV. But as I talk with them, they talk about a 25 to 40% return year over year that they target. And this is obviously a very high return to indicate that there's a high risk. And as the venture capitalists will tell you, out of every 10 investments, maybe one or two will actually produce a 10x return to their investment, which helps to take care of the ones that don't return anything or you lose or you basically get back your money and that's it.
Okay, thanks. Mr. Shea, in your testimony, you emphasized the continued need for credit, especially among startup businesses. And do you believe that lenders overemphasize more profitable loans, like loans to established businesses with larger, greater needs, credit needs? Do these larger loans contribute to the credit shortage for startups that we are seeing at this point?
Well, I certainly think in a competitive marketplace, capital hopefully being agnostic is going to go where it can, where it believes it's going to get the greatest return. As the sources for loans to small businesses have dried up, the existing capital is either sitting on the sidelines or it's going to other places, larger loans. There's a segment of our membership, about 400 member companies, that have investment levels, startup investment levels of between $750,000 and $2 million. And given the current loan limits on an SBA guaranteed loan of $2 million, those franchise investors essentially hit the limit with their first store. So for the people that are trying to expand to multi-unit status, 2 or 3 stores, which is really what they need in order to be profitable in many cases. The challenge that those people face, and that's really the sweet spot, those 400 that have those size businesses, they've exhausted the possibility of financing and capital with the first store. So, yeah, we see a big challenge, and I can't point fingers at what's creating the real bottleneck. Is the capital going somewhere else, bigger loans or not? But we would not consider a loan of $750,000 to $2 million to be an extremely large loan. That's a very competitive loan for a small business, and it's tough to find.
Well, it's less riskier for a bank to lend to older, more established businesses than going and lending to startups.
Right, and certainly in our view is that a franchise fits that category of an established business because you've got a track record and a pattern of history, and again, not wanting to distinguish between franchise businesses and a typical independent startup because we think all independent businesses are great. We just happen to favor the franchise model. But yeah, there's no question, though, that lenders, bankers, non-bank lenders look at a franchise, and when they see a business plan developed by a franchise system, that gives some comfort that there's going to be sort of some full faith and credit there, as opposed to someone that walks in off the street and doesn't have that experience or doesn't have that those kinds of resources at their disposal.
Thank you. Dr. Zimmerman, the proposed health IT loan program, would you say that the proposed health IT loan program be duplicative of the SBA's existing loan programs, or are there factors that distinguish this program?
I don't believe they do. Thank you. No, I don't believe that the proposed legislation does duplicate existing resources through the SBA. With the proposed legislation, the fact that there is up to a 3-year deferment on the payment of interest before the payback begins decreases the cost of this loan greatly, and makes it a lot more attractive for small practices to consider implementing the HIT technology. A lot of the cost savings cited with electronic medical record systems, even in the Federal Stimulus Act, come from savings and not actual revenue. So it's very important to see reductions in costs at the front end, and not saying, well, 10 years from now, this is how much money you'll save. The physician it's a business, and they need to see what the difference in the overhead, my cost right now, out of pocket is going to be. So I don't believe it is duplicative.
We hear that the cost for implementing IT will be like $100,000 per practice. Do you know what will be the cost savings once the IT has been implemented?
A lot of times depends on how well the practice is actually running with the EMR system, and a lot of it has to do with how well the practice has been run before the system's implemented. If they have a good paper system, if it's an efficient office, they'll see a lot more savings and increased revenue with the EMR system. I believe some studies cite anywhere between $10,000 to $20,000 per physician in cost savings, and if you look at the average cost of a implementation, a lot of times that comes out to about a 6 to 8 year period before you have a return on investment, depending on the size and cost of the system.
Thank you. Mr. Fogler, in the proposed legislation or the draft legislation that we have before us, we are allowing for the SBA to use the surplus to reduce the cost of loans for borrowers in the microloan program. And the microloan program has been criticized for the interest rate, the high interest rate the borrowers pay. Would this put more money into the hands of small businesses like yours?
Yeah, I think anything to improve the microloan program, especially, it is much higher interest rates, but at the same time, it is more competitive than credit cards, and at least it is accessible, even though it is limited. So I think it definitely could improve, and ultimately, get more money into the hands of small business owners that are struggling to grow, even though we seem to find ways to do it. It's very stunning growth, but anything could definitely be a huge improvement to helping the microloan program.
Thank you. I have more questions, and I will come back at the second round. So now I will recognize Mr. Graves.